All right. Anyway, all right, let's get going. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities in order to track and discuss, monitor virtual trading house, virtual and prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockBroker.com, BSW, nor its affiliates, or any of their respective offices, personnel, representative agents, independent contractors, investors, licensed financial advisors, registered investment advisors, registered broker dealers. Nothing in the name of the webinar website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics of stabilized options. PSW provides education and training services to meant to teach the risks and such rewards of trading options. And we are not a service sales where to trade. We are not implying guaranteeing any profit. As always, do not trade money you cannot afford to lose. Past performance is not equal future results. Results discussed in this webinar are typical and only valid on that specific or identified date. Your results may vary by access in this webinar. You agree to hold the above harmless. Many losses you may incur as a result of the information discussed in the media identified above. By access in this webinar, you agree to be placed on mailing list and receive our newsletter. Rest assured, we take your privacy very seriously. We will not distribute or sell your information to anyone. Fantastic. I hope everybody's having a fun rally, sell-off, I don't know where we are anymore, but whatever. I hope you're enjoying all the volatility. Let's put it that way. All right, let's see. What is going on in the market? Since I have no pending questions, we'll take a quick look. I know I wanted to short the Nasdaq, and I still want to short the Nasdaq. Okay. Let's keep an eye on that. If 47.50 fails, I like shorting the Nasdaq there. Or if we get stuck up here again at 47.60, I wouldn't mind shorting it either. The dollar's trending up a little bit off this bounce. The S&P, also not a bad short, but I'd like to see 21.30. The Russell there is not so terrible. How's the Dow looking? Let's see. If the Dow fails 18,000, that's going to be a good sign to short. So we're kind of waiting right now and hoping things turn ugly again, as they usually seem to do at the end of the day. Oil had a fun time. Look at that. Well, we called that oil move, didn't we? That's good. See, we saw the report. Here's the thing. Oh, yeah, we'll take a look at the oil numbers. So we got the oil report at 10:30. And it's not complicated. 45 was our shorting line. So when it comes back to 45, we want to short it again, right? So what happened is it went down. We took the money and ran earlier this morning. We knew that it would probably pop on the inventory report no matter what kind of stupid numbers we got out of it. And the inventory report looked like this. It was minus 600,000. That's not really a draw. But because they had built up this expectation that there's going to be a big build, it seemed like a good deal. But the reality is you add up the minus 6 and the plus 6 is 0 and then plus 4.6. So your net build is what's the most important thing. The reality of these oil inventories is the net build is what matters. And the net build in this case was 4.6. That's bearish. I don't care what you say or what you expected, it's bearish. So I said the small draw from the low bar expectation of a big build is popping oil back to 45, which was a good call because it wasn't 45 at the time, from 44, but it's a net 4.6. We haven't seen any other oils yet, but we should get another chance to short as we cross back under 45. So as it's going up, I'm saying let's short it when it comes back under 45. Here's back under 45, and that's $1,000 right there in not even a half hour. That's a $1,000 drop on the futures. And it's so easy to call. It's so simple because we pay attention. You guys are probably getting used to this, right? We know what these numbers are, and we start to understand what they mean. And if you understand the numbers, and you understand what they mean, and you understand the context of the trade, then you understand that it has nothing to do with TA, which is what I was talking about this morning about stuff. It's all about the fundamentals. And that's what this is about. This is a fundamental number. This adds to our fundamental view. I know the idiots are going to buy it. That's fine. That's one of our fundamental things that we know. I know idiots will buy oil into the inventory report no matter what dumb number comes up. But I also know that fundamentally it doesn't support this dumb number. So whatever it is, we want to start shorting. And I was hoping it would get to 45. We nailed 45. We went a little bit over. We got our shorts. We got a $1,000 winner, and we get the hell out. That's it. End of story. It's so easy, and it's so obvious. And frankly, I mean, Craig said this yesterday. I'm so proud of him because Craig said, look, I'm trading less often and making more money because that's what it's about. Pick your spots. If you're patient and you wait, these things come up on a pretty good basis. But you've got to, spend more time studying and less time trading is really the point. He's in a trailer somewhere. I don't know. He's in a trailer in the middle of Germany or some godforsaken country, Spain, something like that. I don't know. So I don't know what's going on with his stuff. Oh, there he is. How's it going? You need a better satellite, dude. All right. What was I saying? Oh, yeah. So you got to pick your spots. So yeah, we're going to look at the futures, right? So how are we doing? See, it's kind of limbo-ish here, so I'm not so thrilled. I would like them to be either higher or lower. I'd like them to be higher, so I don't have to worry about it going higher. I'd like to see these red lines. I'd like to see, not the red line, all these, see you have resistance here. It doesn't matter if they're not the same resistance. You have resistance here, and we know the Nasdaq's being driven by Apple. You have resistance here, resistance here, resistance here. So basically, everyone's testing these purple lines and failing. And that's essentially, what, a weak bounce. It's a weak bounce line. You can see from this fall over here to here is a weak bounce. And if you look at them often enough, you can start getting the feeling what a weak bounce looks like. So we're failing a weak bounce. Now, the Nasdaq, though, they came all the way back. All right, but that's because Apple, do we have Apple there? Look at Apple. Apple's doing this. That's a huge move. 102 to 113 is what, 11 points? So that's like 11, let's call that 10%. It's a 10% move. And Apple is 15% of the Nasdaq. So it would at least translate into 1.5% of the Nasdaq's move is because of Apple. Okay, so that's in 2 days, and the Nasdaq from 46.25 to 47.55 is 130 points divided by 46 is about 1.5%. So the entire Nasdaq move is because of Apple. That's what it boils down to. There's nothing here other than the Apple trade. And also, you have to realize that Apple is part of the Dow. Apple is part of the Nasdaq. On the Dow, every point is like 8.5 Dow points. So you have a 13-point move, 12-point move here, or 11-point move there, and call that 88.5, call it like 90. So that's 90 Dow points because of Apple. And we're from 822 to 8014. So again, the entire Dow move is because of Apple. Entire, all of it. Now, Apple's also in the S&P, but a more reasonable part, I'd say 0. It's probably 3% of the S&P, so probably a half a point of the S&P's move is because of Apple, but a half a point of the S&P is 10 points, right? So half the S&P's move is Apple. Yeah, and if you understand these things, you have to understand these relationships because it's very important. If you understand these relationships, then you understand the mechanics of why this thing is doing that. It's like if you look at a car engine and you don't know anything about an engine, like think of any woman you know, most likely. If you look at a car engine, you don't know anything about an engine, it just looks like a big bunch of metal doohickeys, right? If you look at a car engine and you know what the parts are, like you know what the radiator is, you know what the distributors are, you know what the carburetor is, you understand that, then you understand a bit about it, but you still don't understand it. But if you actually understand how the engine works, if you understand why it's turning, why this belt is moving, why this is connected to that, and then you can start to understand why it makes a certain sound. Then you can start to understand why it might be overheating, right? Knowing what a radiator is doesn't tell you why a car is overheating, right? Just knowing that that's a radiator. That doesn't tell you anything. Knowing the relationship of the radiator to the rest of the engine might tell you why it's overheating. And that's what this is, okay? It's a level, we're just talking about, and everybody can do this. Okay? Anybody can do this. It's an amazing thing. Because all you have to do is take the time to learn and understand what we're actually doing here. And so, little things like that, learning these little pieces of information one by one and adding it to your knowledge is really important because like when you understand how Apple affects the market, when you know the math of it, then you'll see these market moves in a better light. And also that, by the way, one of the most important things you'll ever learn is this 8.5 points per point on the Dow. Because anytime you have a Dow component that makes a big move, let's see, Yahoo, okay. So if we go to DJI, I think they'll have a component breakdown. Components. So here's all your Dow components, right? So when the Dow makes a big move, that's unexpected, the first thing you want to look at is you want to look at your Dow components and see if anybody had a particularly large move. So here we have IBM has 60 down. That's not much though. So nobody had, here's the biggest move, Apple. So if I want to look today, what happened to the Dow? Apple went up 4.4 points. So just today, that's 4.4 times 8.5 is 32 plus 2 is like 34, 35 points. So 35 Dow points today is only because of Apple. Now, if I look at everyone else, now if I take Apple out, I say, well, what's everyone else doing? Everyone else is plus, minus, plus, minus. So everyone else is flat. Apple is up 35 points. So really, Apple is up. And from this, I can pretty much calculate. Here, I can tell you right now, 15, 6, 14, that cancels that. These are both negative. That cancels one. This cancels. Oh, there's two negatives, half a negative, full point negative, 3/4 negative, half negative, back to 1 negative, 1.5 negative, 1.75 negative, 1 negative. There's the one canceled back to 0. 7.5, 1.5 negative. Half of that is canceled, so half a point negative-ish. Back to 1 point negative, flattens out. So now I can tell you from doing this, the Dow is up 35 points. Okay, I just did the math and I say the Dow is up 35 points. Let's see what's actually true. Oh, look at that. 35 points. That's how well I understand the Dow. If you understand the Dow that well, you will not be mystified by the moves that it makes. That way, when something happens, the first thing you're going to do when you see the Dow move, when you're trading a Dow future and something happens, the first thing you're going to do is run to the component table and say, "Hey, is something going on?" And let's say the Dow moved against you. All of a sudden, like you thought it wasn't going to go up, but all of a sudden it goes up. You say, "Why did the Dow suddenly go up?" Oh, it went up 35 points because Apple went up 35. Apple went up 35 Dow points. So I'm going to be less likely to pull out of my trade, because it's only one stock. So the actual Dow, the components, my premise of the components not being strong is correct. One component had a good day. Now, I have to now take into account, do I think Apple will continue to have good days? And we just talked about that in chat. And I said, look, I think Apple's on the way to 120, but not tomorrow. The bottom line for Apple is Samsung had to recall their phones. Apple just rolled out their phones. That's a huge advantage for Apple. You have to give them at least a 10% pop based on that, probably 20% pop based on that. So 120 is a very realistic number for Apple to be at right now because they've got phones to sell and Samsung doesn't. And for Samsung, there's no getting that back. If they miss a week of sales, 2 weeks of sales, 3 weeks of sales, a month of sales is 10% of their whole year. People aren't putting off buying their phones because poor Samsung had to do a recall. Okay, people are, some people are getting new phones, of course, traders, but people who are making a decision between one phone and another physically can't get the Samsung phone. It doesn't exist right now, the one that they recalled. So now it's either the Apple or the nothing. So more and more people, Samsung loses a bunch of customers to Apple. That's a very big negative for Samsung and a very big positive for Apple. They made a huge mistake, just like Hillary did this weekend. She made a huge mistake. Trump jumped in the polls. That's how things work. All right, now whether they get it back or not, that's a whole different story. But for now, there's going to be that change in the polls, and that's what this is. It's a poll, and Apple went up in the polls. That's where we are. But understanding that and understanding Apple is a unique company, of course. Not every company's like that, but also another thing. See, when you hear good news, knowing the Dow is a very stupid index because it goes by a point. So 1 point of Apple is worth as much as 1 point of GE. Even though, as a market cap-wise, 1 point of GE is worth a lot more than 1 point of Apple because GE is a much smaller stock size-wise. So you know that if you hear good news in a $100 Dow stock, it's more important than if you hear good news in a $30 Dow stock. It carries 3 times more weight. Just the price of the stock. It has nothing to do with how good the company is or anything else. It's purely based on the price of the stock. It's a very terrible, stupid way to index something. But that's how the Dow works, and that's what you're stuck with. So when you hear the big guys like Apple or Home Depot or United Health or Boeing or McDonald's or 3M or IBM, when you hear one of them has good news or bad news, you know that's going to hurt or help the Dow a lot. But if it's like, GE or Verizon, now that makes small companies in the Dow. They kicked out a lot of the real small guys. I used to have Alcoa was $8. It's like, and Bank of America is $15. Like, why are they even in the Dow? But if you hear it's one of the smaller companies, if something happens to Intel, something happens to Cisco or Pfizer, it's not going to impact the Dow. It takes too much of a move for them to really hurt the Dow one way or another, or to help it. But it's the big guys you got to worry about. So the guys who are over $100, when they move 5%, that's 40 Dow points just on one stock, just like Apple is today. Apple's move, which is 4%, is 35 Dow points. And it's all 100, well, it was 100% of the Dow. Oh, see, now while we're talking, the Dow went down to 28, right? Apple is still up 4. So it's not Apple. It's the other components are weakening while Apple is holding it up. But if you take Apple out now, take out those 35 points, and the Dow just went red, which pisses me off because that means I should have shorted Intel should have shorted the Nasdaq when we said hit. See, here we go. All right, so everybody's turning down a little bit, and I expect to fall through here because Apple's done. Apple's 4%. Please, what do you want out of the stock? 4%. Apple has pushed the Dow up 4%. It's as hard as Apple can push the Dow by giving it 35 points. And now it needs somebody else to contribute, otherwise it's going to collapse under its own weight. And the other thing is Apple, after a 10% run, what's going to happen at Apple? You see how all these lessons come back, right? The 5% rule. What happens after Apple moves 10%? It retraces 20% of the run. It's going to move back 2 points. So Apple is probably going to pull back down to 110 or this red line, 109, whatever the heck, right? So now I say, oh, that's going to cost the Dow 16 points. So now that Apple's done helping, it's now going to hurt the Dow by 16 points. And the rest of the guys show no sign that they're going to step up and save it. All right, so 16 points brings us right back down to that 18,000 line. So we're going to be right on the line, and panic can ensue if we fail that line. So we're going to keep a close eye on this. It's going to be interesting while we're in the trading session. All right, let's see if anyone has a question. Okay. Do you calculate the 5% after every move up or down? I'm not sure when it, no. The 5% rule is a general name. Look, I made it up. Let's keep that in mind. I made up the 5% rule. It happens to be a really good rule. It's like better than any other rule anybody has about any kind of market movement, but I made it up. And I made it up in my total disdain for TA. That's how I made it up. I made it up because this is all bullshit. And I said, but also because I know what's really happening, because my dad and I used to consult for the big banks and the brokerage houses. And he was a systems analyst, and I was the guy who, it was good because my dad, being a systems analyst, I grew up with him, I could speak to my dad. And I understood business. My dad could care less about business. So I would translate between the bankers and my dad. You know, my dad's company, I was like helping him out. But I would translate between the bankers and my dad. And and I would tell, so in other words, we'd sit down in meetings and they would say, we want our, this is the origination is back in the 80s and 90s. I mean, this is back in the origination of these high-frequency trading programs. We designed some of the original ones. And the thing is that what happens is when people sit down and design these systems, they all have the same goal. They all want to make money. They all want to take advantage of trend changes, blah, blah, blah. They want to be ahead of everyone else. But they all essentially want the same thing. And programmers are very rule-based people. So when you tell them what you want, they're going to give you what you want, although what you get may not be what you really wanted, because the business people have trouble articulating what they want. But also within the bank, there's structure. So the CEO says, I want something that does this. It goes to a committee. The committee says this. The legal department says that. The trading department says this. And everyone has their input. And then there's another layer. I'm giving a real 5-minute tour of this thing. Then there's another layer, which is the fact that there's no such thing as a random number. There are random number generators, but they don't really generate random numbers. So when you start using a lot of random number generators to calculate entry and exit points and find places and test equations, and when you start analyzing tons and tons of data and you start rounding it off, and it doesn't matter where you round it off, but you're rounding it off, the more you round it off, the more times you do it, the more people who have input to the programs and say, because people tend to run to round numbers. So people say when the thing moves nobody ever says when a thing moves 1.3%. They say when something moves 1.5% against us, that's when we're going to do something. They never say 1.01 or 1.09 or 1.912. They say 1%, 2%, half a percent. That's why the 5% rule. When this stuff starts cascading through the computer system, you're rounding this, you're rounding that, you think you're random, but you're not. You think you're doing this, but you're not. You're rounding it up, and everything's moving to a certain place. All these things end up coalescing. And they coalesce at 5% increments. So the sum total, and it's not just within the single program, and then you've got all these people writing all these programs that all do essentially the same thing in the end. And so what they do, if you're bullish or bearish, the programs will tend to meet up at a certain point. Those points are mathematically referenceable, and they're 5%. Now, the 5% rule doesn't tell you where the 5% line is. It doesn't tell you where your starting line is. What tells me where the starting line is a valuation analysis we do on the S&P once in a while. I haven't done one probably in almost a year, but every once in a while we value, because frankly I don't do them unless it changes. I mean, nothing has changed, so there's no reason to revalue the S&P. There's nothing in earnings that told me the S&P is more valuable than it was a year ago. It's not. So you value these changes, and we come up with a number that we're picking for the S&P. So in other words, when I'm doing the big chart, here, these numbers haven't changed in like 3 years, but because frankly the market hasn't been more valuable in 3 years. But these must-hold levels. Now, they're not my target. Our target is up here. But these are the levels that we think must hold, or else the market is bearish. Okay, the time we revalue is when all of the indexes, and we came close for one time a little while ago. We almost had all of them green except the NYSE. But when they're all green and they all hold green for like a couple of weeks, that's when I'll start looking at revaluing. Now, frankly, Apple has caused a big distortion in the Nasdaq for sure. It's caused a massive distortion in the Nasdaq. And so have things like Amazon and Priceline and whatever. There's been a few huge valuations on stocks that screwed up the Nasdaq. This we should revalue because realistically it's never going to come back down. The S&P though is just flat out overvalued. I mean, there's no way it's worth this much. The Dow is where it should be. The NYSE is where it should be. The Russell is where it should be. And don't forget, these are much broader indexes. This is only 100 stocks. This is only 30 stocks. It's not telling you about reality at all. So, so these are the lines. From these lines, we calculate 5% moves. Those are the ones that really matter. Now, that's your question, so I don't lose the thread of the question. Okay, so we calculate the 5% move from consolidation points. So when we're looking at a shorter term, that one is for years. Okay, that one we're looking at over the course of years. But if you're looking at Apple, well, let's go to Apple instead. Because I like this as a gallery view on stock charts. So you have your intradays, you have your daily, and then you have your weekly. So all at once I have like 3 views I can use that are very useful. So step 1, where are my consolidation points? Intraday, we went from here, 105, okay, to 113, and that's like, so when you have a consolidation point, you look for a 5% move off the consolidation point. So 105, is the calculator? Okay, so 105 times 1.05 is 110.25, okay? So that's your move, 110.25. And you see what happened here? Okay, there's your 5% rule kicking in. See what happened at 110.25? I didn't make that happen. That's what the 5% rule causes. At 110.25, you have that. Then we popped up above it, but that's because not everyone trading. Most people trading, most trades are machine trades, but not every trade is a machine trade. And obviously the rule is a benchmark. Like I said, I made it up, but it gives you a good idea of what's happening. So at the 5% move, sell programs start kicking in. And they stop the run-up. No matter how much you want to buy, a bunch of sell programs are going to kick in there at the 5% line. Then the question is, how far above the 5% line can you manage to go? And we went pretty far. We went 3 points above the 5% line. That's pretty good. Okay, so another 3 points is a huge move. And now you're going to say, okay, well, we want to see what happens. If 110.25 holds up on here and we consolidate there and head higher, that means Apple is probably in a very bullish structure. But now, so there's two things to calculate. First, now we know that the 5% line is 110.25. Now we take the whole move into account from 113 and still 105. Even though it went below 105, none of this counts. And by the way, when I say none of this counts, look on a bigger chart. It doesn't look like anything, right? I mean, here's what you consolidated. Actually, you know what? I'd have to call that 104 for consolidation. You know, having a bigger view, I'd say we consolidated 104. So we go 104 to 113 is 9 points. And that's a little bit less than 1 point retraces. So retrace number 1 is 112. And there we are, right? Retrace number 2 is 111. That's the strong retrace. So oh no, I'm sorry. I apologize. It's 20% of the run. So if we had a 9-point run, we're going to have a 1.8 point retrace. So call that from 113, call it 111 is a weak retrace. And we know 110.25 is important. So 111 would be your first spot, 109 would be your second, would be a stronger retrace, but 110.25. So this whole zone here, if we're bullish, and we're going to hold the strong retraces, this whole zone here from 111 to 109 should be really, really hard for Apple to go through. Because it means it's hitting resistance at 111, at 110.25, at 109. So you need 3 different resistance points within $2. That should be like going through mud, right? There should be no way do you see a big thing like this happening through that. Because if you see that, then something's wrong. And that means the move up was probably bullshit. And you see what happened here? Same thing though. We got over 109. This is an opening, so it doesn't really count. So at the open, we popped over. But then once we got over 110, you see how it has to slog up here? It's having a hard time getting up to go. It's the same thing. It should have just as much trouble going back down if we're bullish. If this move was bullshit though, then we'll fall down quickly, and that'll be a sign that it's going to retrace. Now, again, it's not bullshit though. I'll tell you that right now. It's not bullshit because Apple has a fundamental change. Something actually changed, and it's not the same Apple as it was here. Because here, Samsung's phones weren't exploding in people's hands. Here they are. That changes things for Apple. And so if Apple was basically holding up around 110 to 105, now it should be 115 to 120. So we may not even get below this line. See this little red line here? We may not even get below 112, which is what it's a 20, wow. It's a 20-period moving average. So 20 times 10 is 200. It's a 200-minute moving average. So it's a 3-hour moving average. So that's a 3-hour moving average. So we may not even go below the 3-hour moving average of 112. That's where we are now. There's no way we're going below 104. That's a 50-day moving average. But we're not going below 104. All right? So that's what these calculations are. You have to look at your consolidation points, but you really want to look at the consolidation point within the period that you're trading. But then you need to check it by going back. You need to go back in time, look at a longer period to double check. So like I said here, I was saying 104, 105, but then when I took a look over here, I said, you know what, I have to call that 104. Can you see how this candle here, 104 is midpoint, and the next candle, 104 is the midpoint? So I wouldn't say 105. I would say 104 is really the point that consolidated. And also you have evidence over here that 104 was the place it held. See how long it held for? 1, 2, 3, 4, 5. It held for like a week. So if you see something hold for a week, that's a good consolidation. You want to use that line. And interestingly enough, at the time, 104 was also the 50-day moving average. So it's another reason to use 104 in this case. But then from there, you start making your calculation. So 104 times 1.05, 109.20. So again, it goes back to whether you use 105 is 110.25, 104 is 109.20. So this whole area here, 109 to 111, once again, is going to be very, very, it should be phenomenal support. And if it's not, then something's wrong. But I don't, it's going to be, it should be very, very hard for Apple to go below that zone. So I hope that helps. It's not the kind of thing you really teach in 5 minutes. Okay. Where do you see Apple pulling back this year, and what's the support for going on? Okay, no, I don't see it pulling back. That's the thing. I think it'll be surprising to see 110 at the moment. That's why we called along. In fact, we called along last time it hit 105. We took another play because it's just, we don't see any reason at all that Apple should not be going higher. Yeah, okay. Keep an eye on the screen. All right, where are we? Well, you guys are all over the place with your questions. You see any sell on the news on Apple at all? Nope. Come on, you've got a giant fundamental change in Apple, okay? Apple has a phone to ship. Samsung does not. End of story. There's only two. Let's see, hang on a few. This chart. Smartphone sales 2016. There you go. Second quarter shipment volume, 77 million Samsungs, 40 million Apples. So not only, Huawei is not something that anyone buys here. So in America, basically, these are our two phones. We have Apple and Samsung. And probably somebody has a bigger, here's other people. Vivo, I mean, these are not things we use in America, so it doesn't matter. So Apple, Samsung, those are your phones. Apple has 1/3 of the market, or about, and Samsung has 2/3 of the market. So even better for Apple, because that means that there's an even higher likelihood if Samsung can't ship a phone, there's even more market share for Apple to get. So let's say the specific phone that Samsung can't get is only 5% of their phones. That's still 3.5 million phones. If it's 10% of their phones, it's 7 million phones. Now you divide 7 million phones, and let's say this lasts a month. So let's say it's 7 million phones, and we'll divide it by 10, and we'll say 700,000 phones. This is conservatively. That's 700,000 phones Apple picks up, and that's for Apple. That's Well, okay. Well, let's do that. 700,000 phones divided by 40 million. 2%. So that's a 2% bump. Okay, that's like a 1-week bump in Apple sales. That's if only it's 10% of their phones. If it's 20% of Samsung's phones, and it probably is, since they compete directly with Apple, you're talking about Apple bumping 4% more phone sales. That's their whole year bump 4% if if Samsung just has a 1-month problem with their batteries. This is how you do a quick evaluation on something. You want to look at the numbers, you want to figure it out, chop it up, figure out the duration of the problem, figure out how much sales there are. You also have to consider whether or not Apple can actually deliver the product. Of course, if Apple runs out of phones, it doesn't help them that much, right? So there's mitigating factors, but on the whole, obviously it's a huge plus for Apple. There's no sign of this abating until Samsung announces a fix for their batteries. Then Apple might pump back down. But at the moment, that hasn't happened. But see, here you go. It's exactly what we expected for Apple, right? And it's curving back down. And that's going, Wasn't the whole point that we were going to trade the Nasdaq, right? There it is. So then all we do, very simply, wait, short side. All we do very simply is pick up a short on the Nasdaq, and it didn't do it. Why didn't it do it? Try it again. There it goes. Okay. So now we're short one share on the Nasdaq at 47.50. Didn't cross yet, but we'll see what happens. Okay. In fact, it went right away against me. But I expect Apple to fall a bit further. We expect it to go down a bit more. So it should get at least another, how much was this move? 59. Oh, wow, that's a big move. So 55, let's say to 50. So we hopefully should get 4 points. So we'll set a quick goal of 46 and see what happens. All right, and he fell below 25, and we want to see that also. We don't need the dollar. The dollar's going down. That's going against us. So we've got to be careful of that. Then we'll go slash on YM. See the Dow fall below 1800 too to confirm. And of course, Apple cost the Dow a few points. And that's going to filter in shortly. It doesn't immediately hit it. It's not like it prices in that second. But the traders start doing it. And see, then robots start taking it up. And they all start trading and adjusting and going in lockstep. And they all work together. And that's how you get these cascading moves. Wow, that went way up on us. Okay. Don't tell me Apple went back up. That'll piss me off. No, but we expect, of course, Apple's going to hit this resistance line, get some more buyers, and it's going to eventually fall back to here, though. We're going to look for it to come back down to this line. And at that point, we'll probably be done with the selling. Now, the Nasdaq, since it's going back up, though, I'm going to probably want to get another one. So we're at 525. If we go 325, it's only going to move my average up to by 150, so that's not that exciting. So I'm not really, unless I can get two, so I want to get at least a 2-point bump. That means if it's at 425, I'll add another one. If I add another one at 425, that means my average will be some 225. So let's see how that works out. Right here. And remember, when we're looking at these, we want to look at the count. This side is heavier than that side. So the pressure is probably down in a second. Okay, so there's a lot more heavy numbers here than there are here. That means there's more sellers than buyers. It's very simple, really. And that can change in a second because one person puts in an order for 200 and the whole thing goes boom. So, it's not the be-all and end-all, but it does give you an indication of where the general pressure is building up. All right, so it's going back down now. So in other words, we didn't get a chance to improve our position, but that's not. See, now we're back to even. We didn't get a chance to improve our position, but that's fine. I don't mind being right. And of course, the 50 line is going to be a bit bouncy. It's another part of the 5% rule, okay? All these even number lines are going to get bouncy because that's another thing that happens with these computer programs. They tend to consolidate on these even numbers. All right, well, I guess we'll come back to that. I really was hoping to double down. Oh, well. Any ideas on gold, silver, and the miners? Remarkable this morning. We're looking for a stronger dollar. So if we're going to have a stronger dollar, then it won't be good for gold and silver. I would not really buy gold, silver, or miners until the dollar is more like 100. But if we get a nice run on the dollar and it's back to 100, that'll be as low as you're going to see gold and silver probably get. They'll get depressed, and then you'll know the only reason they're down is because the dollar is strong, and then when the dollar weakens again, everything will be, they'll shoot back up. So that's the time to get in. On that 5-10% long-term play, why did you pick that particular call and put strike? Ah, yes, okay. Buy. I don't know what I picked, frankly, but we'll take a look. Don't remember. Where were we? We were 2019, weren't we? Oh, yeah, okay. ABX, an offset. Oh, that was a dollar. Where do we talk about SPY? That's some other play. Oh, and by the way, I did mention the ABX short puts, but the net of the short puts is low enough that I don't mind owning ABX. We're already assuming a 20% drop in ABX before we're forced to buy them. Okay, so that's different than going long on ABX. Well, in my mind, it's different than going long on ABX. I'm selling puts on ABX at a price that I'd like to buy them at if they get cheaper. So that's the way I would go long if I'm going to play it. But again, I don't think that's getting the best price. But currently, when I'm looking for something I like as an offset, that one jumped out at me. And especially in the case of the play above in the morning, we were talking about as an offset to a dollar play. So there's no better offset to the dollar than gold. All right, so SPY. Oh, I'm sorry, this one. Okay, this isn't not a portfolio play. It's an example of a very conservative trading strategy. But okay, so we were looking out at the longest SPYs we could find, which were, not 2019, but the month before. The 213, 210 spread. So why do we pick 213, 210? Well, okay, first of all, okay, in 2 years, SPY. Okay, so in 2 years, where do I think the S&P will be? Well, 2 years ago, let's see, 1 year ago, 2 years ago. 2 years ago, it was here. I'm not counting the dip. It was 190. Now it's 210. That's not really a huge move, right? That's 2 years ago. In between now, what do I expect to happen? I expect there to be a correction, but I expect also that we'll keep growing higher because the supply of money the Fed has will eventually start moving. The supply of money that's out there, which is huge, will eventually start moving and it'll cause inflation. So for deservedly or not, stocks will go up over the next 2 years. Not necessarily because they're better or they earn more money, but because money gets cheaper and stocks will get relatively more expensive. So I think this trend will continue, but I wouldn't count on any kind of great growth. So I'm not inclined to take a risk with the S&P. So I'm being conservative, and I'm assuming the S&P will be essentially flat. So the trade, whatever it was, oh man. Where the hell? Oh, I know why. That's why I'm confusing myself. Here. Okay, so buy the 213, sell the 2. Oh, I'm sorry. Oh no, that's right. You can buy the SPY 213. Oh no, I'm sorry. So we were selling. So we bought the actual SPY itself, 213. So it's at 213 now. We sold the 210 because I don't think that we're going to be significantly higher. I'm not willing. And also, by the way, we're talking about a conservative play. I don't want to take a chance. Even if I thought the market was going up, I still don't want to take a chance. I want to buy protection. You know what the chance I'm taking is in selling the puts. I'm selling these 185 puts. So the chance I'm taking is saying I'm willing, if the S&P goes down to 185, which is $22 down. So not 22, sorry, 18. No. 30 would be 115. It would be 215, right? Yeah, so it's 28. So $28 down, which is like 15% lower. So if it drops 15%, then I'm going to commit to buy more. So if the S&P goes down 15%, I will commit to buy more. That's my real risk. This isn't the risk. I'm covering a 10% drop by selling these calls. So I'm covering a 10% drop, and then if it does drop all the way to 15%, I'm going to double down, and that's going to make me end up with 2 times the amount at 193.50. So do I want to buy SPY for 193.50, which is 10% below the current price? So I either make 18% if the S&P is flat or up, I will make 18%. If it's down, it has to go down 10% before I lose. So if anything above 10%, I don't lose. If it's flat or anything over flat, I make 18%, and between minus 10% and zero, I still make some money, something between 0 and 18%. So I'm talking conservative play. But there's nothing wrong with that, okay? Because this is a 2-year play. No, I'm sorry, it's December of 2018, right? Let me make sure I got that right. Longest ones out are, okay, December, the end of 2018. This is the end of it's 2 years. Okay, it's a 2-year play. So this is the end of 2016, and we're talking about the end of 2018. So it's a 2-year play. So here's the thing. Think about it. You have to, the premise of this is because of the overall, we were talking about this in the context of the overall performance of the S&P, which is this. Here are 10-year periods, right, for the whole last 100 years. Minus 0.08% and minus 1.2% are the 2 worst 10-year periods ever on the S&P. Now, keep in mind, though, we did have a year not very long ago, 10 years ago, in fact, that we were minus 40% or minus 30%, whatever the hell it was for the year. We were, like, incredibly low. So at any given year, you can get slammed on this play. So don't delude yourself that you can never lose. But if you hold on, it comes back. If you keep playing, it comes back. So here's the thing. That trade idea, if the S&P is down 10%, you're even. It has to be lower than 10% for you to lose. In any long-term period, that just flat out doesn't happen. And I don't want to say you can't lose, because obviously you can, but it's super duper unlikely that you're going to lose. And then there's a very good chance that you'll make 10% a year. In a flat market, you'll make 10%. In an up market, you'll make 10%. But the key is that you'll make 10% consistently and you won't lose. And when you make 10% and 10% and 10% per year, consistently, you double your money every 7 years. Okay, that's the key. Consistently make those returns, and you will get incredible amounts of money. If you stick with it for 20 years, you'll double in 10 years, and then 10 more years after that, you'll have 4 times more than you started with. That's how you grow a portfolio. So like I said, if you take 25% of your portfolio and do a very, very super conservative play like this with 25% of your portfolio, that 25% in 20 years will be double what your current whole portfolio is. That's what you should be doing with a large portion of your portfolio. You should be invested in very, very safe 10% annual return plays. Okay, and you will, on the whole, you won't always beat the S&P. This year you'll be pissed. This year you'll be pissed. This year you'll be pissed. Here you'll be happy. Here you'll be not that happy. Here you're happy. Here you're happy. You'll be happy every year, but you will be happy with the results long term. And you will be happy with the lack of ulcers because you have such an incredible amount of headway in your bet that you don't have to worry about it. It'll be incredibly surprising any year you don't make money. You'll be like, what? How could I? It's like, wow, this must have been a terrible year if I didn't make money. Because it has to be down more than 10% for you not to make money. And even when it is, it doesn't matter because the reality is you're not stuck with the trade. You can still roll it and adjust it and do things with it. That's why it's very important, though, that you don't make it. You don't want to make 100% of your portfolio like this. You want to be able to adjust the trade and make moves. Like Warren Buffett, frankly, Warren Buffett put another $5 billion into the S&P when it went down. Obviously, he had a fortune in the S&P through all his stocks. And when it went down, he made a $5 billion bet. He sold $5 billion worth of S&P puts at 900. Okay, we're at 2,000 now. He sold $5 billion worth of puts to people who bet him the S&P would be lower than 900 in 5 more years. Those people were morons. But he got the bet. You know, at the time, I was like, Warren, can I have their numbers? I want to lay these bets off. You know, it's just, you have to have a long-term outlook and long-term logic, but it's so easy to make money like this. All right, so where are we? Oh, why am I looking at that? Oh, yeah, we have a trade out, don't we? Let's take a look at how we're doing. Yay, look at that, money, $70. Oh, that was our target, damn it. Nobody. Here you go, right? This was our target, 476. I guarantee it was below that while I was yammering, right? So, just because we missed our target doesn't mean I deserve it. It's not the market's fault that I was talking while it hit my target. So if it goes back over 7, I'm going to get out, and it's back over 7 while I'm saying it. All right, so it's not looking good, and I'm going to get out. Oh, wait, might be saved. Oh, one more. Let's hit it. Oh, and below, wow. So now I have a stop in at 76. I mean, 46, sorry. So I hit my goal. It's like a $100 gain or something like that. And there it goes. 85. So we made $85. Okay. All right, so that's all it takes. Okay, I had a goal. I had a target. I hit my target. I'm done. End of story. That's my trade. Okay, now we have support over here. So now you look for a fresh horse. So now I say, well, okay, now if this breaks lower, I'm not going to go back to Nasdaq, but now I'm going to look for the S&P to start breaking down. I'm going to look for the Dow to break down. We said below 18,000. We like that one. The U.S. already is below. And how's Apple doing? Apple is still hanging out up there. So it's not Apple's fault. They're trying to hold up. Don't blame Apple for this mess. And it's not the dollar's fault either. The dollar's way down here. There's just the same general selling is recommencing. The same selling that we see every day. That selling pressure is still there. It's not going away. So do not get complacent about this stuff. All right. Was I done with that topic? I think I was. Okay. Oh, the calls and puts on the S&P. Wow, how do we get off the topic? Oh, that's funny. I totally lost track of why we were there. Okay, so why do we select those calls and puts on the S&P? Well, because, again, it's being conservative, okay? I want protection. That's my number one concern. I want to get protection. So I said, okay, we'll sell at-the-money calls, and I don't need the extra couple of bucks. I'd rather be here. I'd rather have the money and have a little bit more protection, even though it's below the current strike. So I'll sell these, get a good price. I'm selling as close to the money as I can because I get the most premium close to the money, right? You know, on this trade, let's take a look. On the 10s, it's $22, and and SPY is at 213. So these have 19 in premium, okay? These guys also have 19 in premium. These guys have 16, obviously, 16, 14, 12. Okay, so my best premium is 19. That's number one. But these have 19 in premium, and they offer me a bonus $3 of downside protection. I like that. These guys don't. Now watch what happens here, though. So these two have 19 in premium, but these guys give me a bonus $3 protection. These guys, from 205 and 24 is 230. So these guys have $17 in premium. No bonus protection. No, wait, I'm sorry, hang on. They have $17 in premium and they offer, the difference obviously is 7. They offer $7 of bonus protection. So that's where your trade-off starts coming. So now I'm saying, okay, well, they have 17 in premium, but they offer $7 of bonus protection. They have 19 in premium with $3 of bonus protection. Oh, and also, though, I get called away at a higher strike. That has to be taken into account, too. I get $5 more when I'm called away. So you have to factor in all those things. Then on the other side, I think it was the 180s or the 185s, you just look down here to the point of diminishing returns. Like, how much risk am I willing to take on SPY? Do I think SPY is going to fall 15% in 2 years? And the answer is not really. And since I'm going to sell these guys for 15 bucks, that's another 10% protection. So really, in a vacuum, as far as just selling the puts, I'm selling I've got 25% downside before this thing costs me money. So the S&P can drop 25% before it costs me money. Now, let's look at the current one. Let's look at October, for example. Now, what's 25% more than where we are now? Well, we can do this in a head. 50 bucks, right? So let's say $55. So $55 is 268. So let's call it 270s. No, I'm sorry. Yeah, no, that's right. 270. I'm correct. All right, so 274. All right, so let's say we had sold the 270 calls and we fell. Well, the S&P would have to fall 50% basically to go this far in the money. In other words, for us to be No, wait, okay, I'm sorry, I'm doing it backwards. Let's do it, here's an easy way to do it. If the S&P falls 25%, that's 55 bucks. $55 below 213. Or I'm sorry, if we were 55 out of the money now, that would be 270. Oh, no, that's the correct number then. So 270. So if we had fallen 55 out of the money, that would be 270. So that's where we'd be right now. We would have sold these 50. We would have sold the puts based on the same logic. The S&P fell 25%. There's still something wrong with this. I'm trying to figure out what it is. Because they're not taking into account the advantage we had in the first place. It's very complicated to do this in a roundabout way. I'm just trying to say for an example, but it's a hard example. All right. So let's say, just to round it off, let's say we sold the 240 puts. So the 270 is ridiculous. That wouldn't happen. Let's say we sold 240 puts. They're now $27 because not only, okay, so in other words, based on that logic, the S&P would have had to have been significantly above 240 for this to be something we would have done. But let's say 2 years ago we sold the 240 puts, and don't forget we sold them for 15 bucks. So the S&P is now at 213, and we're only down 12 bucks. That's really not that bad, for one thing. Now, for the other thing, though, in reality, we're not losing this money because all we're going to do now is go to 2019, and we'll say, well, what can we sell for 27 bucks? And we say, oh, look, I can sell the 215 puts, which are right at the money. All right, so now I can roll. I still got the 15 in my pocket from what I originally sold. I'm now rolling down 25 further dollars, another 10% down. And it doesn't cost me anything. So if every 2 years you can roll down another 10% without paying any additional money, you'll eventually get to zero, right? So the S&P would have to go down and stay down for a very long amount of time before this kind of thing hurts you. But now, you could say, well, given that logic, shouldn't I be greedier? No, it works because we pick a nice conservative target to start with. At 185, we've got $30 leeway. We have 15% leeway before even, before it's even, and even means zero, don't forget. If it actually isn't 185, this goes to zero. It has to be below 185 before these guys even get their money back. So our break even is 170 on the S&P. On this side, it's 170. And you know, there's a lot of things wrong with the world if the S&P is back down to 170. So it's not something we're really expecting to happen. And again, it has to go down there, stay down there, but then even if it's at 170, we'll be able to roll it to 150, 140, 130, whatever down the road. So when I say it's a conservative position, there's more to it than just the position itself, because we know how to treat those positions over time. We know how to fix them. We know how to adjust them. So if something does go wrong, we'll fix it on the fly. And that's why I'm going to say, over the course of time, over 10 years, 20 years, if you follow the strategy, it's an incredibly high percentage strategy for making a good, steady 10% a year. And don't forget, you get your dividends too. So it really is a great way to play if you want to be conservative. And also, by the way, if you have tens of millions of dollars, you have to do things like this because you can't buy 50,000 Apple calls. You'll own all the Apple calls. There's certain, you can't. You have to lay off your bets in certain places. And so if you have a huge fund with hundreds of millions of dollars to deploy, you really can't just buy all kinds of stuff. You can't buy all stocks with your money. You have to do some conservative things so that you can put $50 million to work here and $20 million to work here and so on and so forth. You can't put everything into a couple of stocks. It doesn't work that way. And these are very liquid too. That's another good thing about them because, frankly, in a downturn, when you do have to make an adjustment, you need something very liquid. Considering what you said in chat about SunPower, would you make any changes to the OOP positions or ride it through? No, ride it through. I mean, we may adjust it, but we would make an adjustment, a positive adjustment. But, when something goes against us, where are we in the options opportunity? 5%. Ooh, getting close to 100 there. Can't be hurting us that badly. $3,000, yeah. All right. Oh, no, it's not. Oh, see, look, the position's net neutral. We lost 1,200 here, 2,000, 3,800, but we made 3,200 on this part. That is the beauty of hedging. We're even on this position, so it's not actually hurting us at all because we sold these calls, fortunately. So what we will do is we will buy these back. That's thing number one, is we're going to buy these back because they're already down 80% and they don't expire until 2018. So I'm not going to wait 16 more months to collect my last 78 cents. That's stupid. Okay, we're going to free up that slot. Position-wise, we have long on the 8s, and we're below 8. So we have the long 8s, and then we have 2 sets of puts that are hurting us, of course. But there's no reason to adjust them because we have 8. Again, we have 16 months for them to get better. So we can give them a chance. Also, again, we sold the 13 puts for $350. We sold the 10 puts for $290. So we net 7 on here. We're still in the money on those. So the only ones that are really a headache are these 13 puts that we sold. And we had hoped that we found a bottom on SunPower and it was going higher, but unfortunately it did the opposite because the idea wasn't to have all those puts. SPWR. Oh. That's annoying. Wow. Okay. Anyway, they're in a bad cycle, and we're going to have to ride it out, and it's going to be a long-term play. But we will adjust it when we get around to it. Like I said, immediately, just in case they do come back, immediately we want to buy back these long calls. These short calls. Because, okay, either it's going to come back, or it's not going to come back, or it's going to be down, and we're going to want to sell some more long calls. Because if I look at SunPower now, what do we got? 10. SPWR. Okay. So we buy those back to 78, and then we can sell the $8 calls for $220. Oh, these are 2019s already. So we can sell, and we could also roll to these longer positions. What do we sell? The 13s? So we sold the 13s. What? Not those. These. Okay, close March. It's too confusing. So we sold the 13s and they're $5, right? So these 14s are $4. So we could add a few and drop. We can drop them. I'm sorry, the 10s. We can drop them down to the 10s and just sell a few more to make an even roll down there. So then we picked up 33% on our position. Still out of the money, but it's a much more comfortable sale. And we want to wait a year. We want to give them more time to come back for us. Okay, but meanwhile, on those other ones, on the ones that we sold, that were 2018 Januaries, okay? We buy those back for, were they the 15s? 15 calls, okay. So we buy those back for, it looks like 68 cents was the last. It looks like 75 cents maybe. So we buy them back to 75 cents, and then if we sell the same amount of these guys, then if we sell the 10s, I'm sorry. So then if we sell the 10s, we're going to get $2 for the 10. That's 3 times more money for selling the 10. The 8s. It's twice as much money for selling the 10s. We're not selling anything right now. I'm saying that we're going to buy it back and we're going to wait. If it goes below 750, we're going to sell those 8s because we just, at that point, we're into preservation mode at that point. We just want to get our money back. If it stays above 750 and comes back to 10, then we'll sell the 10s as they get more expensive. All right, but either way, we're going to, no matter what happens, we're going to pick up more money than we owe on these. So the sensible play now is to buy it back, open up a slot, and then whenever we want, we can pull the trigger and pick up a couple of $1,000. All right, and again, take into account there's a negative cycle on the news, there's a negative cycle on solar, there's a negative cycle, because fuel, all right, oil is cheap, bad for solar. There's a cheap war for pricing, that's bad for solar. Solar City's got problems, bad for solar because it's just part of the overall market that demands chips and so on and so forth. And of course, and then the overall economy and the market is not strong, bad for our solar stock. So there's many, many factors pushing it down right now, and eventually they'll wash out. So it's not like I don't want to abandon the stock, and I do want to take advantage of lower prices if we have. All right. Hey, what happened? Ooh, 46,760 on NQ? Wait, did I miss something? Went back up? Am I confused? I must be confused. No! Oh, man! We missed it. All right. Damn it. Oh, well, I hope somebody got it. Shit. Wow, that was fast. Son of a bitch, I wanted to get back in. All right, I'm sorry. Damn it. See, you can't. That good lesson on the futures, though. Don't take your eyes off it if you're playing the futures, because, God, this is fast. I want, as I said, I wanted to short these guys when they crossed their lines. But look what happened when they failed their lines. Boom, boom, and boom. All failing really hard and fast now. All right, nothing I can do. I'm not going to chase anything. That's it. It's just not going to play now. It's a shame. But that's what you do, though. You set your lines. And the fresh horse that we were going to pick was this one, right? We wanted to get him below the 20 line. You just, when you get out of one trade, you look around and say, who's going to be my fresh horse? Who's the next guy to cross that I feel comfortable playing on the way down? And you just move on to the next trade, that's all. That's why you should never fear getting out on the bump, because then you just look for the next guy of the line and say, okay, he'll bump too. Ah, damn it, I would have loved to have caught that. Sorry. All right, all right, may as well get back to chat then. Unfortunately, we have all our other shorts, so they're going to make us a fortune. What's the best hedge now to protect our longs in the OOP? TZA is my favorite. I always love TZA. The STS is good too. They're both good. I wouldn't have them if they weren't both good. Is this still the OOP? Yeah. What do we have? We have the TZA. Let's look at this one. Oh, see, this one's still a good trade. TZA is at 30, and this trade, now, if TZA goes up 33%, right, or 10 bucks is 33%, that means that the Russell has to fall 11%. But if the Russell does fall 11%, this trade returns $50,000. It seems like a lot of money. This trade returns $50,000. Currently, the net of the trade is $10,000. So this trade pays 5 to 1 on a 10% drop in the Russell. On a 2.5% drop in the Russell, you're still going to get $25,000 back. I'm sorry, on a 5% drop in the Russell, you're going to be at 35. You're going to get 25,000 back. So it pays 2.5 to 1 or 5 to 1, depending on if the Russell drops 5% or 10%. So that's a good trade, right? Our TLT is just about in the money. Very nice. A lot of these trades, everything was too high on us, and now it's all coming back nicely, so we're doing very well. Coffee's still profitable, even though it's had a bit rough time. Cake's kind of flat, but I like that trade. Lebu, we're going to get a huge bump on Friday. These guys expire. Lebu's at 43. They had a 1-to-4 split. So 1 share became 4 shares of these at a higher price. No, wait. 4 shares became 1 share? 4? Okay, sorry. 1-to-4. 4 shares at this price became 1 share at this price. So in other words, you multiply all these by 4. So these are the 20s, and these are the 36s. Okay, so what we actually have here is a 20-36 spread. And obviously, Lebu's at 43. We're miles in the money. We're going to get paid on these. What are we going to get paid? We're going to get paid 10 times 4s. We're going to get paid $4,000. These expire worthless. So this trade will be net $4,000. What is it now? It's now showing net flat. Okay, so as soon as we get paid on this, this will turn into 4,000 plus in our advantage and not be net flat anymore. So we'll make $4,000. In fact, actually, it's 500 negative right now. So on Friday, this trade will flip $4,500 in our favor. And you can't go out and get this. It's not real pricing. It's only because everything's zeroed out because of the split. But we still have these old options. They still exist. They're just not priced anymore. But the reality is, what we're going to do is we're going to it's going to do exactly what we wanted to do from day one. We're going to get $4,000. When we went into the trade, it was $34.50. So it was $350. We spent $350 on this spread in March, and here we are 6 months later getting $4,000 back. So that's a 10 times. That's a 10 bagger right there. We liked it so much that 3 months later we did it again for the next period out. So we did the December. So here we are 3 months later. We had an opportunity to do it again. We did the same trade again, basically. And now that one's on track to pay us the full amount. So I freaking love this thing. The Biotech Ultra ETF. Super fantastic. Why were we here? I forgot. Oh yeah, hedges. So we don't have STS. Oh, that's what I just discovered. We don't have STS. We have the TZAs, which I love, and we have the SQQs, which is the Nasdaq Ultra Short. Now, with Apple, this is going to be a tough sell. All right, it's still the same price basically that we bought it for. This is going to be, and don't forget these are not favorable prices anyway. These are the worst of the bid in the ass when you see them. So with the Nasdaq, we have this one, and basically any catastrophe in the Nasdaq though, and this can easily go to 18 because here we're only talking about a 20% bump to take us to 18, and this is an ultra. So again, if the Nasdaq falls, this isn't a triple though, it's a double, I think. If the Nasdaq falls 10% or 7%, whatever one it is, so if the Nasdaq falls the same as we're looking for the Russell to fall, this one pays 3, but the net here is like 0. That's why we liked it. In fact, here it's a net. This is net $100, and it pays back for every 100. It pays back 3,000. So yeah, that's why we liked it. This has an incredible payback on cash. And we do not have SDS because we just felt better about the Nasdaq. Now, given Apple's new position, though, it's a little less likely that the Nasdaq one will pay off. But that's okay because look how much smaller it is. So we put most of our eggs in the TZA basket. Okay, that's where we're counting on as our primary hedge. All right, and I'll have to look at it. We'll do a review. We got to review all these things. We'll have to do some reviews tomorrow because we have to make sure we don't have any adjustments to make. I don't see any September things though. Actually, we're fine. Okay, so other than labor, which is just going to expire for us in the money, we don't have any Septembers that we have to deal with, so we're in good shape. Oh, wait, this SQQ. Oh, that was clever. See how smart I am? So what do we do here? We bought the long January calls, right, for 165. This is even better than it was before. We bought the long January for 165. We sold the Septembers for 75, so that nets 90, but we only sold the Septembers. These are going to expire worthless, and now, if we want to, we can sell Octobers and get more money. So we can actually make a profit, even though we don't make money on the insurance itself, we can actually make money just selling calls. It's a brilliant play. I'm sorry, I don't remember everything I do. Sometimes I look at my own plays. I'm like, wow, that's a brilliant freaking play. Because we took the long position, so we have our long-term insurance. We sold short-term protection. The short-term protection expires so much faster than our long-term protection that we can now turn around and sell more of it. So we sold that in July, and here we are 2 months later, and we've made the full $1,500 back. And that's half of the money we laid out for this. And of course, selling the we didn't sell any puts. Oh, I'm sorry. We already knew that. Damn it. Okay, we already knew that. We took that for granted because we sold these, but we already have a January spread. I didn't realize there's no puts involved here. So we have the 15-20 spread in January. We already decided this was going to be a winner. We left these short puts, and these short puts are expiring. Now we can still sell October, but that diminishes our spread. So I'm not sure we're going to do that. But it was fantastic selling this. We got $1,500 for nothing. It's great. Oh, so happy. All right, let's see. Oh, stop teasing me about NQ. I missed it. Wow. Okay, a lot of questions, guys. It's 2:30 already. Okay. All right, where are we? SPY, 10%. SunPower. Oh, closing units. So, no, we talked about that. Well, you might not have been there. We talked about that in chat. The risk-reward for USO is such that we really don't think it's a risk. The profit was only 50%, which it's funny I say only. We're so greedy because we make so much money on our positions. So like we make 50%, we're like 50%. It's like a fish you throw back. The thing is though that we made 50%, but we could make 200%. If oil drops to the next level down to about $40. We're going to make 200% on it. So I think even though we made 50%, it's kind of only on track to where we think it's going to be. So I'm looking for USO to come all the way back to, I think, 10? I think we're expecting 10 or less. Let me see. USO. Well, it's already at 10. So we're talking like 950-ish or something like that. And I think we sold the $12 puts, so they would be $250 at that point. And currently, those USO puts are, where are they? There they are. They're $1.88. So we could make 70 more cents, let's say. So we can make 33% more, 70 more cents times that is $1,400 more dollars. So we can double so we made $1,300. We can make another $1,400. And I know, like I said, it's up 50%. 50% is great, but we should be up 100% at least. So, we have until October. I don't see any reason why it's going to not do what we think it's going to do. OPEC could have an agreement, but I think more likely they don't have an agreement, and it'll be catastrophic. And again, I don't see it as being particularly risky. We only put 24 into it. So at the moment, Would I do, here's where the problem is though. Would I do this from scratch? Would I right now put 3760 into it? No, I would not. So I guess this falls into a category of when in doubt, sell half. So whenever you're not sure what to do, cut your position down half. Take half off the table. That's the smart way to play this right now. Take half off the table. All right. Apple just dropped. Oh, really? It's getting exciting, huh? Nope, pop back up. Ha 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 ha! I love this market. It's so funny. Yep, boom. Boom goes the dynamite. Somebody must have said something. Such a silly market. What do you think when to close the U.S. Open? Oh, so the Apple drop. What about the consumer sentiment pulling back on purchases due to the election uncertainty and blah, blah, blah? Yeah, of course. It's why, look, we're not bullish. That's why we're not bullish. That's one of the many reasons we're not bullish. Consumer sentiment's not good. Consumer discretionary income, not income, discretionary income is not good. People don't have money to spend. Okay? In other words, if your taxes are going up and your medical expenses are going up and your auto insurance is going up and all this crap, and they go up $100 a month and you get a $50 a month raise or a $100 a month raise, you don't have any extra money. It doesn't mean the fact that you got a raise is where they get really crazy. They have these income reports. They oh, income is up and poverty's down and blah, blah, blah. No, you need to raise the poverty line. Poverty is not down. It's just that the poverty line should be up 10% higher. You haven't raised it in 10 years. Okay, you go try living on $20,000 or whatever the hell the poverty, about $12,000 is the poverty line. Well, hang on, I'll tell you. Poverty level. Let's not mischaracterize the poverty level. Oh, $23,000. Okay, $23,000. This is the federal rate. What? Federal poverty level numbers and threshold. This is why I have these two numbers in mind. It's twice the 100%, 200% FPL. Oh, okay, I'm right. The poverty level, the actual poverty level, $11,770. Oh, who has time for this? Jesus Christ. If you and your family make between 100, you qualify. This is about how you qualify for stuff. So anyway, so the poverty level for an individual is $11,770. Okay. So let's say. So the conservative media, which is I don't want to get into it. Okay. The media, the liberal media. Let's call them whatever you want, but the media has been all day long talking about how great it is that so many more people are out of poverty, okay? $11,770 divided by 12 months a year. Shit. Try again. 11,770 divided by 12 is $980 a month divided by, well, you're surely, all right, sorry, let's do it probably. You divide by 52. I don't know. Let's keep the months. Let's talk about monthly expenses. So $11,770 divided by 12 months. Okay, $980 a month. That's assuming nothing is taxed and they don't pay. Now, of course, obviously, as you know, it's unfair that these people don't pay taxes. How dare they not pay taxes? They've got $980 to spend for the month. That is, after all, $30 every single day that they can just go willy-nilly buying $5 packs of cigarettes or whatever. I think cigarettes are like $10 now. I don't even know what they are anymore. Holy crap. I'm not even going to do the math. I mean, come on. That's the poverty level, $980 a month to live on. That's assuming that you take 100% of that check home, that you have that much left, that you have that much to spend. My kids can't live on that. And they have a house and food. Wow, it is stunning, isn't it? I mean, when you really think about it, that is just horrifying. So that's what people are out of. They're out of poverty, folks. Let's celebrate. Woo! Okay? They can't afford a cake. They can't afford candles to celebrate with, but they should have a big party because they're out of freaking poverty. They might have $1,000 to spend. Who knows? It's horrifying. Anyway, all right. So that's what I think of consumer spending. Sell numbers fake. What about sentiment pulling back? Okay, so we talk about sentiment. And so, yeah, going into the election is going to get worse. It'll look... you already have one bunch of people who are upset that Hillary's winning. Now you're going to have a whole bunch of people who are upset that Trump was winning. And that's what happens. The closer the election is, everybody's upset because everybody's terrified the other one's going to get in office. I wish there was a way that this thing could be fixed so that it wouldn't be so jumpy. Can you use time for 5 cents? You can use 5% on any time frame you're trading, but it's less reliable the shorter your time frame is. That's why you always want to go back and make sure you know where the bigger lines are. That's why sometimes I draw fat lines and thin lines on my charts. You have to go back and look at the whole broad picture. So you have to know where the big real 5% lines are, then look at your 5% lines. And in the places where your short-term 5% match up with one of the other ones, that's when you might have a winner. That's when you go, ooh, that's a great line. That's how I say that all the time. Oh, that's a great line. That's what I mean. It's a confluence of several different things that come together where I say, oh, that's going to be a lot of support or a lot of resistance. By the way, so getting back to this is why I don't chase things, though. Look at this insanity. Up, down, sideways, crazy. That's why before when I said I missed it, you missed it. Don't chase anything. Your reaction to when you miss something is not to jump in and try to catch it. You say, I missed a good entry, I'm done, I'm not going to play. Thank God I did that, because it came right back up. Aren't some of the sell numbers fake? I take it you mean the futures. Yeah, well, people, what they call spoofing. People put in orders they don't mean to fill, and then they withdraw them as soon as they go in. In the aftermarket, most of the numbers are fake. Most of the orders you see aftermarket are fake. During the day, most of them are real. So, when the market's open, that's why I don't trade much after hours. But when the market is open, usually there's real orders because they get filled too fast for people to be spoofing. I'm not saying nobody does, but I'm just saying it's more difficult because you get very likely to be filled when you put in numbers in the daytime. At night, though, you can put in all kinds of crazy numbers and nobody fills it because there's nobody else trading. What's the best hedge sheet? Oh, we talked about that. All right. NQ down, target. Yeah, well, no, we don't have I don't have a target. I don't know what's going to happen right now. We're just watching it, basically. What's the take on natural gas? Natural gas, we think, is $3 this year, and we've already hit that goal, basically, and $4 next year. That's natural gas. What it does in between here and there, I have no idea. I'm hilarious. Okay, I wish I knew why, but I hope that's in a good way. Is he out of NQ? Yeah, we got out of NQ quickly just because it wasn't doing what we liked, and then immediately dropped further. That's just the way it is. But we made a quick $85, so I'm happy. Where do you think SunPower will hit resistance? 750. With September options expiring on Friday, is there a concerted effort to drive things up? It's hard to tell. They don't really. Don't forget that the people who control the stuff, the big fund managers who have some element of control on things, they're not always looking to push things up. Sometimes the guy might have sold. A guy might have sold 10,000 Apple calls against his position. He doesn't want to get called away. All right? So here's what I mean by a fund manager controls something. I've got 2 million shares of Apple. I have $100 million worth of Apple, which isn't really that much, frankly. But I have $100 million worth of Apple. And I sold 10,000 calls against my shares of Apple. I have 1 million shares of Apple, sold 10,000 calls at $110. Now Apple's at $112. I don't want to get called away. So you know what I do? Right into the close on Friday, I dumped 100,000 of my shares. I dumped 10% of my shares at a low price. Why would I do that? Well, because I'm going to force the price of Apple down. If I can, I'm going to do the math first to see if it's going to work based on the volume of Apple and so on and so forth. But if I suddenly start dumping shares into the close on Friday, and or if I get one of my friends in the media to start a rumor that hurts Apple, that's another way to do it. But if I dump shares Friday, here's what happens. I dump 10% of my shares. 100,000 is quite a lot of shares. I dump 100,000 shares from 102 to 100. I'm sorry, from 102, from 112 to 110. I push Apple back down under 110. Now, if I'm lucky, my selling starts to panic. And this is where it's very effective if I have one of my media friends spread a rumor, right? So if I'm lucky, the selling starts to panic, and somebody thinks somebody knows. They go, oh, somebody's selling. They must know something. Meanwhile, I'm only selling 100,000 of my million shares. So a panic starts, and now Apple goes from 110 to 108 to 107. What do? As soon as my call expires worthless, I put a market order in to buy back my 100,000 shares for 107. So what did I do? I sold from I keep saying the wrong number. I sold from 112 to 110. I kept selling Apple. My average exit is $101. I only wanted to do this so that I wouldn't have to pay the callers, right? I know why Apple's falling because I spread a bullshit rumor and I started selling. I caused it. I know exactly why Apple went down. Not inside information, but I know why Apple went down. Now, Apple ultimately falls to 107. I know why it fell. It fell because I started a rumor and I started selling and it caused a panic. I know exactly why it's 107. My exit price is 101. I start buying back at 107 and get the price back up to 109. So now I got my million shares back, my short call was expired worthless, and I made a profit for the day. That's a good day, right? That's fun. That's what you do when you're a fund manager. It's evil, it's disgusting, it should be illegal, but it's not illegal. It's technically not even illegal. That's the rumor part. It's not technically illegal what you're doing. It really is crazy. And that's the kind of stuff that happens around expirations. But you don't know which way you don't know where the interests lie. There's cross purposes and different interests. So there's no one certain thing that everyone does. But when Apple has a big run up, you expect probably more likely somebody's going to want to push it down than push it up right at the end. So they already had a run up. Oh, 43.63 on oil. That's not bad. I mean, obviously 43.50 will be some support, and then we'll see what happens. 42.50 is big support. Below 42.50, though, you're all the way down to 40. Well, I told Reuters this was going to happen this week. The guy interviewed me. I told him exactly what was going to happen in oil. Let's see. Somebody misspelled something. Okay, that's what I got out of that. Mining. You got somebody tell Jay you got to restart your thing. Just get out and come back. That's all. SunPower 77. You did the OOP trade, but it did not include the $10 call sale in the OOP. Let's sell 5 of the thing. I think we already had it. That's why the shorts are from an earlier time or something. Where are we? Didn't include what? You did the OOP trade, but it did not include the $10 call sale. Okay? SunPower, $10. There are no $10 calls. We sold the $10 puts and we sold the $15 calls. There are no $10 calls. So I'm not sure what you mean. So I'm confused by your confusion. All right, I screwed that up with the original trade in the OP somehow. Okay, but there's different dates. That's what I'm saying. So in other words, the 2 from 7.7, there's 2 from 8.11. So in the original call, yeah, I agree. There was only these 2 in the original call, and then there was 2 other legs got added later. I don't have time to go back and check each leg, but I'm sure that's fine. What is your next buy point to create a position in IBM? Ugh, I haven't thought about them in a while. They got away from us. We kind of lost interest. Yeah. No, they got to be back down here. They got to be back at like 145, and even 145. I mean, I liked them when they were down here. I liked them at 130. I certainly feel 145 is a fair price for them, but I've got to see at least 145 before I want to start poking around IBM again. I mean, they got to be on sale. If it's not on sale, I don't want them. Oop, IBM. What's your view on the short term? Okay, no, we like natural gas for the long run. I don't have a short term view. Okay, if there's a hurricane, it's going to go flying up. So I certainly want to be in it. I don't know when or if it's going to go up, but I do think UNG is going to just keep going up, basically. So it depends. If you're talking about 2000, I mean, look, in UNG, we think it's going to be, what are we shooting for? $10 next year. It's at $9 now. I don't think that's very, it's not like we have a big, a thing here. We're up a certain amount. We're net. Well, it's a pretty good net. 5,500 minus 12 is 4,500, 4,300. So you're about 4,200 bucks here, and the potential is 10,000. So we can make double the money that we have now, and I see no reason that we're not going to make it. So, from my point of view, I wouldn't get rid of that. I don't see any reason that trade's not going to pay off. Okay, yeah, 5% rule is absolutely, it's the easiest. It's funny because we used to never have a chart for it. Now we have the big chart which has the 5% rule kind of embedded in it. It's just math though. It's so easy. Once you get the hang of it, it's just math. You just sit there and do the math and you watch how it works from in between. So if you're a chat member, feel free to ask more about it, but it's like, it's such an easy way to see what's going to happen in the market. Do you see a plan on Dow Chemicals? Yeah. I'm not. Dow Chemicals is having a good time because oil's cheap. Oil and natural gas are big ingredients in their stuff. And also, by the way, there's going to be pollution issues for these guys. They're big carbon emitters. So I think they're enjoying really good market conditions, but I don't think that they've got any particular reason they're going to run up high. And again, they're not on sale, so I have no interest unless they come back down to around 40. If they go 20% off, I might be interested because I like them. It's a good company, but I certainly wouldn't pay up here. And again, yeah, you say they're paying 8 times earnings with consistent margin and growth. The margin is not going to be consistent if oil goes up 25% and natural gas goes up 25%. They won't be consistent at all, okay? Because that's a huge input cost for them. Then also their transportation costs go up. Several issues like that. Also, if the global economy slows down, it won't be good for them. So, and all these things are very possible problems. So I don't want to buy the stock based on that nobody thinks anything's going to go wrong. I would like to buy, when they're at 5 times earnings, I'll get much more interested. And believe me, they were just at 5 times. I love people think that's okay. Here, look, this is them. They were 40. Okay, that was this year. Last year they were at 40. The year before they were at 40. Here they're at 40. I'm not buying them at 50 when every year they go to 40. Including this one. If I have to wait till next year, I'll wait till next year, but I'd rather buy them at 40 than 50. That goes back, I told about those Levi jeans all the time, right? It's the same thing. I'm not going to buy Levi jeans for $50. They have to be on sale or I'm not going to buy them, out of principle, because they're always on sale. At some point during the year, jeans will be on sale. I don't need jeans badly enough to pay $50. When they're $40, I'll get interested. That's how you should be about stocks. You don't need to own Dow. There's no need. There's no catalyst that says they're absolutely going to explode for this reason. If there's no absolute reason that you think if you don't buy it right now, it's going to go way up on you. There's no need to own it. And frankly, even when there is a catalyst like that, and even when you think something's going to go up, it's still not on sale. Don't buy it. If you only buy things that are on sale, you're going to be a much, much happier person. If you see the U.S. going higher, then we should wait to buy gold or ABX. Yeah, yes, absolutely. Wow. You know, you get these screensavers and some of, they get the random screensaver pictures. So my computer just put up this incredibly gorgeous picture of a flower. I can't believe how nice it is. My other computer, not this one. All right. So, whoa, I was going to check the screen. So yeah, we think the dollar's going up. I'm not sure what it's doing at the moment, but we think it's going to go up long term. And only because, look, the Fed is either, if they tighten in September, this is way, way too low. If they indicate they're going to tighten, they'll still drift higher. And we expect to get back to 100 at some point. I mean, all the U.S. has to be doing is not tightening when Europe and Japan loosen, and then you're still going to get the dollar going higher. So what's going to cause the dollar to go lower? That's what you have to think about. Why would the dollar go lower? The dollar would go lower because we are easier than Europe and Japan. Is that going to happen? It's so unlikely that you have to be bullish on the dollar. There's really no alternative, right? There's virtually no chance at all that policies are going to shift so much that we become looser than Europe and Japan. Therefore, dollar strong. Very simple premise. What's your shorting line on TF? I mean, if it was higher, I'd have an easy shorting line. Russell. There you go, 1250. See, that was our shorting line. If it goes below 1200, that becomes our shorting line again. Obviously confirmed by the other guys, but you want to look for a significant move, right? Now, what's your bounce? From 1250 to 1200, here's your 5% rule, right? From 1250, consolidation, to 1200, which we know is support from back here. Okay? So what is your bounce? Your bounce is 20% of the drop, so 50-point drop, 10-point bounce. So your weak bounce is 1210. Your strong bounce is 1220. Okay, so that's what you're going to look for. If you want to play crazy intraday stuff, 1210 is the weak bounce line, 1220 is the strong bounce line. So that's how I said. Well, that's what I mean when I say look at it. You got to look at the chart in various times. Now we move to the hourly, and I know that 1220 is a strong bounce, and we went right plowing over that on the first try. But then we failed the strong bounce line. It's a very bearish signal. Failing the strong bounce line is always a bad signal. Failed the strong bounce line, drop like a rock, come back, and now we only make a weak bounce. So we made a strong bounce, and now we're making a weak bounce. That's not good, right? If we fail the weak bounce here and come back, that means the next time, think of it like a ball running out of energy, right? It's coming, it's like bounce, 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 dead, right? So the ball is coming back down. If it hits the 1200 line and starts dribbling down, then it's probably consolidating for a move lower. And I think that's where we are right now. I'm pretty sure all this is just consolidation for a move much lower. Because, look, and again, now if you look here, we had to run from 1,000 to 1,200, which is 20%, right? And that's, is that 25%? No, wait, 20% is 1,200. Another 5% of 100, oh yeah, it's 1,250. All right, that's 25%. So we had 20% run, we had a 5% overshoot, boom. But let's assume, though, that the real run should have stopped at 1,200. And I believe that because valuation-wise, I believe that. So the real run should have stopped at 1,200. That means that what we're looking for is a retrace of the 1,000 to 1,200 run. So that is 200 points. That means you're going to get a 40-point drop to 1160 right here. And you see 1160, if you draw the line across, you can see where it actually matters. So we're going to see 1160 and below 1160 all the way down to 1120. And really, though, again, is where it's not math, it's an art with the 5-cent rule. You know you can round it off, so you really want to look at 1150 and 1100 as your two next major lines. So if we fail 12, we got a pretty clear shot to 1150. There's not really much intermediate support in this area. It didn't stay there long enough to create much support. So you're talking about a drop from 1,200 to 1150, and if that fails, forget it. Then we're all the way back down here, and we'll have lost, years of growth. Just disappeared. In weeks. And here, that's a funny chart, right? When you pull it out to here, yeah, like I said, 1150. So if you get back here if you get back to 1100, you're all the way back to you've lost everything since 2014. You're gone. And you can see in the big picture how that would be not even a big retrace. You're just getting back in the channel. We went out of the channel, back down. Now we're back up. Now we go back down and we settle, and maybe this is a fair value here. But that's a problem because the Russell is 2,000 stocks. And it tells us a lot more than the S&P does. The S&P is 500 stocks. So if the Russell is fairly valued at 2014, that's 1,800, right? Now, isn't that funny? Because 1,850 is my must-hold line on the S&P. But if the Russell is falling, then you can expect the S&P to head down here also. Oh, God. Okay, we got to cut this thing. Sorry, guys, I'm not going to have time for all these. Okay, we talked about Dow, shorting the Dow, current position on Eric. I don't have really much thinking on Eric, but we can follow up on that in chat. I can take a look. Can you explain strangle when you buy and sell a put in a call? Are you expecting a big, what? I can't explain a strangle because it would take too much time. You buy and sell a put in a call? Yeah, I'm not sure. I mean, that's what a strangle is. I'm not getting that. Wells Fargo is getting beaten up. At what price would become attractive? Ugh. You lay off without planning to. You suddenly lay off 5,000 people, which is, maybe it's only 5% of their workforce or whatever the amount is, though. That's disruptive. It's disruptive for a whole quarter at least. So I think they'll underperform. They'll have all kinds of excuses. They may have fines. They may have congressional hearings. They'll pay fines. There'll be consumer lawsuits. I would not be jumping in. Okay, if they get beat, if they go much lower, they'll start getting interesting. But here they're really just back to their normal range. So it's not like it's a huge sale. They're just back to where they usually are when they're not running up too high. So not attractive yet. But another, you get down to like below 40, it starts getting good. Give me a call on dollar strengthening. How low would you? Well, come on. That's anything under 15. I think on ABX, I'm a buyer. Look, if the dollar goes up 5%, gold's going to be down between 5 and 10%. So gold is what, 13 now? Is it 13 still? 13, yeah. Okay, so 5% on gold is $100, let's say. It's not even $100, but $75, whatever. So 5% on gold is $12.50, roundabout. All right, it's obviously it hurts ABX, but not much. $12.50, they're going to make some great money anyway. So so if they hit 15 in reaction to something like that, I would certainly be a buyer. Now, gold could go down twice as much as a dollar, 10%. You're down $130, you're all the way down to $1,200. Still doesn't actually hurt ABX. I'd still be a buyer, but you're taking. If you assume ABX, here's the thing. If you assume ABX is pulling gold out of the ground at $1,000, right? Or not, let's say it's 1,000, it might be 900. But if they're pulling it out at $1,000, and at 1,300 they're making $300, right? At 1,200 they're only making $200. It's 1/3 of their profits. So logically, it justifies the 30% pullback. All right, but I would say it would justify a 30% pullback from 22, not from, 30% off the highs. because these were assuming that the money, that the 1250, 1300 would stick. Now we're not so much assuming that it's going to stick, and people are getting worried. But I think still, this is where you should be. It may go below. When people start panicking, though, you know how it is. As soon as gold goes to 12, everyone's like, "Oh my God, gold's going to $900. Gold will be $500." Here's the guy wrote an article. This is what happens in chat. People say, "Oh, this guy wrote an article says gold's going to be worth $40 soon." I'm like, what? People start extrapolating those idiotic stuff out of these changes. So it could go much lower. I wouldn't care though. I'd just buy more. But at 15, if I didn't have any, at 15 is where I'd start buying. I do have it, so we aren't going to be even interested until it hits 13, 12. Unless it really sells off, we're not going to double down because I'm perfectly comfortable with that position now. Any comments regarding the upcoming holidays in China? Well, no. I mean, this is the thing. We don't want to have a bad impression going into their holiday, and their holiday starts tomorrow. So I think there's a big effort being made to prop up our markets right now because you don't want to have the Chinese say, "Oh my God, we should be selling like crazy." So, oh wait, they're already closed though. No, I'm sorry, I take that back. They're already closed. They're not open tomorrow. Tomorrow's Thursday, right? They're not open tomorrow, so it's over. So there's nothing for them to react to. So the trading will be thinner for the next 2 days because there's some portion of our total trading is Chinese trading. Trading will be thinner. Chinese markets aren't going to be moving. Nothing that happens in Europe or America is going to affect China for the next couple of days. But I don't think it's a big deal. Not market moving. You think Draghi killed off? Hang on a second, I'm going to get that. Hello? Yes. Yes, Jackie, I'm doing my conference. Yes, it's Wednesday, isn't it? Okay. Say you're sorry to everybody. Say sorry, America. Hang on. Oh, put you on speaker. Say sorry, America.
When are you done?
What? I'm done very soon. Usually I'm done about 3 o'clock.
Call me when you're done.
I would have been done sooner except the phone kept ringing.
Bye.
Bye. Okay. Imagine my daughter wants to ride home from school or something. All right. Do you think Draghi held off thinking the Fed would raise? Do they collude openly? They don't collude openly, but they certainly collude privately. I mean, frankly, it's not that private, is it? Of course, they collude. They get together. They have meetings. They come out and they make speeches that are similar. I think that's collusion. The drug, yes. I think that other people are holding off because the Fed's raising. Because look, in reality, you might not be able to get the presidents to say this kind of stuff, but the bankers are more academic, and they are going to say to each other, they're going to say, our Fed is going to say, hey, we can afford to take a hit by raising rates. And in fact, frankly, what they did last week was most likely a test to see how pissed off we get if they raise rates. So, you know what happened? In other words, like last week, a bunch of Fed speakers came out and said we're raising rates. I think 6 different guys came out and said we're absolutely raising rates. Of course we're raising rates in September. Yes, so rates are going up in September. There was no question that the rates were going up, and the market went boom and tanked. All right? Then they come back, and then what's her face on Monday goes, no, we're never going to raise rates. What are you kidding? And the market goes flying back up. But that was them testing. That's how they test the waters, okay? They convince you they're going to raise rates, and they see how the market reacts. Then they convince you they're not going to raise rates, and they see how the market reacts. And now they have to do the math and say, okay, so should we raise rates or should we not raise rates? Because here's how the market will react when we raise rates. This is what academics do. They're like scientists. They're experimenting on us. So, frankly, I think the experiment was successful. I think that we barely had a reaction. I know everybody freaked out because they haven't had a market drop in God knows how long. But reality-wise, this isn't a big correction. Here's the Fed convincing you that they're going to raise rates, okay? So they're saying, you know what, at worst, and I would draw that conclusion from this, say at worst we're going to test the 200-day moving average again. But you got to look at that in the big picture. In the big picture, it's like, yeah, well, we were cruising along. We started the year here. We might test back at the year, but we're going to be flat for the year. And the Fed doesn't care if the market's up or flat. They care if it's down, but it's not down for the. It's only down off the highs. It's not down for the year. And they have to raise rates. So they say, when's the best time to do it? We want to absorb this shock and try to get through to the end of the year in a more positive note. That's what's going to happen. So I think there's a very high chance they're going to raise rates next week, but I don't think it's going to be the biggest deal. 3 o'clock. Okay. All right, guys. Got to kill it. Let's see. One more look at the market, see how it's looking, and it's flattish. So now, so tomorrow we got China's closed. There's not much data. We got the Fed next week. Could be a lot of drifting into the Fed. Could be almost nothing happening. But I still see a lot of selling pressure. Apple is holding up the market still at the moment. And it'll be interesting to see what happens when Apple stops going up. That's when we're going to start understanding what's happening. When Apple is no longer going up, and that will probably happen between 115 and 120, which means we still have Apple helping for a bit longer. But when Apple stops going up, then we're going to see what's real. And then next week the Fed, so just constant craziness. So plenty and plenty to talk about next week, all right? All right, have a good day, everybody. Thanks.